Hi, I'm Jim Pierce with Baton Investing. Everyday investors like you come to us when they realize that their current investment system just isn't working. We give them an investment process that's beaten the S&P 500 by over 300 percentage points since 2003, takes just 30 seconds a month to use, and most importantly, will help you achieve your financial dreams. Now today's free stock tip is about a company called Travelzoo, which you can think of as combining elements of Groupon and Orbitz to offer deeply discounted vacation packages and other benefits to its users. They also offer deals on restaurants and car rentals and other things. But in other words, helping travelers travel inexpensively and conveniently. Now, since going public in 2003 at $7 per share, its stock price soared up above $100 within a couple of years before slowly dropping down into the $10 to $15 range where it is today. However, its underlying financial condition is improving, so much so that it now earns a perfect score of 100% from our investment strategy based on the fast grower methodology, which are stock picking rules we developed from legendary mutual fund manager Peter Lynch. Now, we think Travelzoo is about to break out to the upside, and here's why. Peter Lynch, by the way, if you don't know who he is, managed Fidelity Magellan Fund from 1977 to 1991, and over that period of time had an average annual return of just under 30%, which is just incredible. And he did it by identifying companies who were able to grow their earnings faster than the overall market, yet were priced like average stocks. So he developed something called the PEG ratio, which is the price to earnings to growth ratio. And what he did is he divided the PE ratio of a company, and in the case of Travelzoo right now, its PE ratio is about 13.6, something like that. And he divided it into the average rate of growth in the company's earnings over the past 5 years, which in the case of Travelzoo, they've been growing at around 35 to 36%. So that works out to a PEG ratio of 0.38. Now anything under 1.0 is good because that means the market is valuing those earnings at a lower rate than what they're really growing at. So this is a very good PEG ratio. However, he also wanted to make sure that the rate of growth at which a company was growing its earnings was sustainable. So he wanted to see an annual growth rate in a sweet spot of about 20 to 50%. And for Travelzoo, they're pretty much right in the middle of that with an average annual growth rate over the past 5 years of 35%, which Lynch felt was sustainable. Finally, he also didn't want to see the company using a lot of debt to achieve that growth, so he wanted to see a debt-to-equity ratio of less than 10. In the case of, and that's long-term debt, by the way, in the case of Travelzoo, it's 0. They don't have any long-term debt. So here's a company, very solid PEG ratio, growing its earnings at a much faster rate than the market's valuing them, with no debt. Now, what's interesting is Travelzoo reports the next quarterly earnings report on July 16th, which is in a couple of days from when I'm talking to you now. And in the week leading up to this, over the past week, its share price has crept up about 10%, which suggests that a lot of the insiders who know what that number is going to be are accumulating the stock because they know it's going to be a good number. So if you happen to be listening to this after the 16th, still take a look at the stock, what that earnings report was, because this is a stock that could very easily get back up over $20 a share. So we recommend buying it up to 15 bucks. If it's already over 15 by the time you hear this, then it may be too late. But the symbol's TZOO, Travelzoo is the name, and we're recommending up to $15 a share, and today it's trading between $12 and $13 a share. Now, Travelzoo is just one of 10 stocks that we currently hold in our Baton portfolio. Every month we identify the 10 highest scoring stocks according to our system that we use to evaluate more than 6,000 companies that trade on U.S. exchanges, and rebalance our portfolio every 4 weeks. So if you want to know more about how the Baton system works, just visit batoninvesting.com and click on how it works. There's also a 3-question assessment you can take to determine if Baton is right for you, and quite frankly it's only probably right for about half the people who visit our website, but maybe you're one of them. So check out the website and take the assessment while you're there. So go to batoninvesting.com now, and I'll see you again soon with another free stock tip. Thank you.